Hello, this is Derek as well, Chief Investment Officer for Shelton Capital Management, with another Shelton CIO Minute. As of yesterday's close, even after the recent weakness of the last 2 months, the S&P 500 is up 12.6% year to date. As has been well publicized, most, if not all of this return has been concentrated in only 7 individual companies. Most other stock indices are flat year to date, including not only small cap and mid cap indices, but emerging markets as well. The one area of global markets with some strength has actually been developed non-US markets, which is up over 7% year to date. Now, narrow markets are unhealthy, and one way to identify a healthy market is breadth, measured by the percentage of the stocks in that index or market that are above their 200-day moving average. It means the market's being supported by broader economic fundamentals and not necessarily concentrated returns from some hype or mania that might be going on and pulling the market along. Now, using this metric, the S&P looks a lot less healthy. Even though it's up over 12% this year, after the recent drawdown, less than 40% of the stocks in the index are above their 200-day moving average. The NASDAQ, which has a concentration of tech stocks, is even worse. It's up 25%, but less than 30% of those stocks are above the 200-day moving average. Meanwhile, overseas in the developed non-US markets, over 50% of these stocks in that index are up above the 200-day moving average, representing a stronger, broader advance. The message is that while our domestic markets have been stronger performance-wise year to date, international markets might actually be in a healthier position. And despite the gloomy economic news from overseas in some places, expectations may also be low, and those markets may be in a better position to perform well going forward. For further information, don't hesitate to contact your local Shelton Capital representative. This has been another Shelton Capital CIO Minute.